What's up, you guys? I hope you all had a really good weekend. Last week, I was pretty sick with COVID and my voice was thrashed, so I didn't really make any videos, but I was taking a lot of trades. I did actually close out the calls that I had on Tesla. I posted this back on January 12th on X. I'm going to go over why I ended up closing this out for a $35,000 loss, why I did end up entering Tesla calls for 220. I'm still in those. And we're going to go over where I see Tesla and a bunch of other tickers going, because I've been talking about Disney, I've been talking about Mara, I've been talking about Firm, a lot of companies over on X, and I think that if I kind of explain to you guys what we're looking for in a lot of these stocks, you guys will get a better understanding of what I trade and how I trade, as opposed to just Tesla. But let's start with the Tesla position first, because it's the biggest loss I've taken probably in about a year and a half. At the end of the day, you guys have to remember too, I'm a portfolio manager. While the name of the company and the Discord and everything is traders helping traders, I feel that there's this unrealistic expectation in the market that people have to where your portfolio needs to be one or two trades. They're constant snipers waiting for the absolute best entry at all times. And it's like, when you really look at big money managers, that's not how it looks. It can't look that way just because of liquidity reasons. So instead, what I focus heavily on teaching within the academy is the trifecta of, number one, the mechanics of good trading. So building an edge, which is technical analysis. I have 10 to 15 different scripts that are all profitable. But just because you have a profitable trading script or a profitable trading bot does not mean that you're going to be a profitable trader. That's where the second part comes in, which is building your own custom risk profile and risk strategy. I kind of shit talk college a lot, and I don't think that college is really needed for a lot of people, but the one thing that they teach you in investment banking is risk profile and how to determine risk and build your own risk profile based on probabilities and thinking like a quant trader. Quanting basically is taking data, whatever it is, and trying to predict the future based off of data points. So I'm a quant trader. I do look at chart patterns, but mainly I'm running strategies that are very pinpoint entry and exit requirements to take past data and see if we can predict that pattern again in the future. This is why I have such little attachment to my trades. Number one, I've been doing this for nearly 9 years, so you have to be dead inside at this point if you've been doing this as long as I have. And number two, after you've triggered probably about 100,000 trades at this point in my career, you don't feel the same as the first couple of times that you've triggered a couple of your trades. And then the third thing that you need is adherence to the risk profile and plan. So the actual ability to fucking stick to the thing that we're trying to build here. And this is why it's so hard for many traders and investors, because the same is for investing. You still have to have a proper risk profile depending upon your time horizon for your investment, what your income looks like outside of the market, time to retirement, etc., etc. And then you actually have to stick to that while having some sort of edge in the market to find undervalued companies. So I ended up closing out this position specifically. Now, this position started with $50,000, and that was a profit that we ended up making back in December from the calls. So number one, we're already up, which is good. From a risk management standpoint, this is already not a risk off position, but we're already playing with house money, which can, number one, just allow me to be a little bit more aggressive with my position, or number two, it could just allow me to not take a loss overall because we carried that profit over. So I said, Tesla, it's been a while since I took a loss like this. Shit happens. Every winning strategy has a drawdown and has failures. To hide from it is worthless. Instead, learn to build proper risk profiles so you'll never be able to lose it all at once. Allocation of capital in this trade is very small relative to the fund, just one of many. It's Friday, so we reposition, and this is how things play out. I'll have a video update later, which this is the video update now, a couple of days later. But basically, the reason that I ended up doing this, and this is a screenshot from the private Discord, which you guys can get access to with the first link in the description for $5 a month. But the reason I closed this out is that my strike was so far out of the money, and I wanted to reposition what capital I had left in the trade into a better priced option. For those of you who are more advanced when it comes to trading, or if you really do want to learn about options, there's a phenomenal book called Options, Volatility, and Pricing, Advanced Strategies and Techniques by Sheldon Nattenberg. It is one of the best books when it comes to actually learning how to price out options, and this is why I don't just hold an option in perpetuity. I'm usually balancing it out by rolling every single Friday. So I said rolling these over to March 15th, 220 calls. From the start, we plan to allocate 50 grand towards this trade on Tesla for the next 90 days. Closing the further strike March March calls and taking the 20,000 left, putting it into the March means that no more capital will be added to this position going further. Now, the reason that I did that is because that option is just a better moving option. There's more volume, which means that all of your Greeks are going to be much better. And overall, when people want those contracts, it's easier for you to get out of the trade since we always want to have liquidity. So now let's move into the actual chart for Tesla. So we had this bullish order block that was sitting here and we had a liquidity zone pushed right under it at about 227. Last week I was posting on X saying I had expected this to pull back down into this liquidity zone, but that I thought we were going to tag a ton of people out, probably do a stop loss hunt, and then rip our way back up to 240. I was not expecting the pull all the way back down to 212 so soon, but you can see that we have this bullish order block down here, and even though we haven't pulled all the way back to the middle to retest, the bulls are stepping in before earnings. So all of this liquidity, everybody who wanted to get in down here last time who couldn't, and I'm not talking about retail like you and me, I'm talking about hedge funds who specifically want positions at 210 to 195 are going to start filling their trades going into earnings. That's why we're seeing this bounce. And I do think that earnings we will probably push up past 260, and this is why I'm still in my March calls. Now, if this doesn't end up happening, guys, I'm not betting the farm. I know it seems like a very big position, but relative to net worth, to the fund, to the allocation of capital, just for options alone, it's very small. But learning how to actually understand risk and manage it appropriately is something that I'm going to be dedicating this next year to by building one of the best risk management courses that I'm going to be able to create through actual strategies and procedures. But more of that's going to come later on this year. So let's talk about now at the S&P 500, because I currently have puts on SPY. I'm doing very well on these. I was going to take profit when they were back down at 472. But the reason that I ended up going short was because we had this nice push up on SPY as we ran from 468 all the way up to 477. We see this wick here as we took out this high. This is going to be our order block. We pull all the way back, and just like we said before, there's a lot of people who wanted to get in short here, but they didn't have the time to. This is why these order blocks formed. Same situation with Tesla, how they wanted to get in down here, but there just wasn't enough time because we gapped up so fast. Now these people are going to want to go short on SPY up around this level. So that's why we saw this draw all the way back up to 478. This would be the time to go short, which is when we decided to take our put position. We had that big drop, push back up, and now I'm hoping that we're going to continue to sell our way off back down to $466. Let's talk about Mara. I posted a video over on X the other day about this, but we were calling this out over there for a while. Mara and all of these other mining companies and crypto companies in general were forming a classic market bubble slash market cycle. So basically, when we're looking at these bigger time frames, we get these massive run-ups from, about 2, 3, 4, 5x. In this case, we ended up having a firm run from $7.68 all the way up to $30. Now, what happens is when these stocks get beat to shit, there becomes a point that obviously investors, smart money, start to look at this and say, is Mara really worth only $7 per share? And it's normally within this point here when we're extremely beaten up. This is when smart money is really taking a look and they're saying, all right, I think that this company's fundamentally undervalued. Maybe we should start allocating a portion of maybe speculative capital from the fund into something like this to maybe 10x our money. And in this case, we start to see this push up. Obviously, we have earnings. So now here's a fundamental potential push. So we have earnings, we get this big continue run up, and then at this moment, we get the potential speculation of an ETF approval. So at this moment, if you're a hedge fund, and this does not just go for Mara, guys, this goes for any stock that you're looking at, Tesla or whatever. If you're a hedge fund and in the past 2 months, your investment's up 132%, do you think you're going to be buying more into this? Of course not. Who's mainly the people who are going to be continuing to bid this market up? It's going to be retail. And so it's usually at this point where we see this massive run up where, if you look at this, we had from December 14th, 1 week and 6 days, a 90% push. So who do you think is buying into this rally? And I'm sorry if you guys were the ones who were buying, up at the top here, but it's not big money. It's not. Now, the thing that you have to understand is that all of the guys and girls who got in down here, if you're trying to sell hundreds of millions of dollars, you cannot just sell like we can. You have to have liquidity. So as retail is starting to get in up here and we're getting this greedy phase, guess who's there to catch the bag now? All the guys who got in down here at 7, 8, 9, 10, they can start selling off their positions because retail is going to buy it up completely. And then once we hit this top around 30, we see the order block come in. We notice that this sells off. This means now that all the hedge funds who really wanted to get out here, they're going to get get out if it touches again. So Mara bounces back up. We get in this zone. Now, remember, guys, you have to remember what moves the market, right? The only reason what made Mara stop here at $29.18, right? It was the fact that there was nobody else out there who would bid the market up any higher. So you have to realize if all the smart guys and girls are getting out here, the only way for this market to continue to push up in Mara's case is if more money comes in. And if the people who can actually move the market are pulling their money from it, there is no way that this is going to continue to push its way up, which is why it's sad, but it does not matter if ETF approval was there or not. There's no reason. Like, there was no upside. We already expected that. So it's not like big money's going to step in now and be like, oh, ETF approval. Like, they've known about that, guys, for months. Like, so this is why we see this massive fade. I fucked up because I went with poorly. We talked about options pricing and volatility in the beginning of this, but I went with poor shit positioning when it came to my puts. I actually would have made more money because of implied volatility. I would have made more money just shorting straight shares. I would have made 41% instead of making like the 38% I made on my puts. But this is a complete beautiful example of not just looking at a chart and saying, okay, this is overextended, but understanding why. And this is why liquidity levels are so important. You have to understand where these levels are because we can't move the market. Like, anytime that you're wrong in a trade with Tesla, right? So when we had this break under here, all this liquidity zone is saying is like, when we come under this support, not a single person is going to bid the market up. So that's why, like I said in the beginning, I don't get mad when I lose money because it just means that somebody else does not believe in the thesis I have. I can't move the market on my own. I need them to, and they're just not stepping in. It's nothing personal. So let's take a look here too at a couple of other trades. So I also called this out, MU. This was on January 14th. We had this beautiful squeeze that was setting up. If we take a look today at what happened with semis, awesome day. Same thing, guys. Here, look, we have this order block set up here, order block set up here. As this comes through, the bulls sweep this up, and this is the level they want to get in. So we get this bounce off of support. We get about a 2.5% run today, and I'm expecting MU to continue to run up to about $87 because we know at 87, there's more liquidity. There's order blocks sitting up there, and they're probably going to want to take their profits off the table once we touch that level. Let's cover DraftKings because this one has a really good setup as well, talking about bullish order blocks. We have this nice bull flag, big breakout after earnings, beautiful consolidation. Yes, we have been rejecting, but look what happens. As we come in and make this lower low, we get this sweep, big bullish order block. Price comes back up. Remember, all of these people who wanted to get in DraftKings down here at 32 to 32.50, once we pull back into the block, they're going to buy all this up, which we see, and then we're hoping to get this bounce. So I'm expecting DraftKings to bounce here, push through 34 this week, and hopefully run up to about $38 in the next month or so. I hope this video helps, guys. If you want access to all my other trades that are free, you can go check them out on X or in our Discord community. And if you want access to all of my trading bots, there's over 50 of them coded by myself, as well as tons more. You guys can get access to all of that with the second link in the description. Thank you guys for all the support. I'll see you next time. Peace.